theoretically impossible. It's like that's what we're building. We're building what's impossible today, but what's possible in the future.
You worked directly under Paul Tudor, who became famous for predicting Black Monday.
He's famously a huge gold bug as well. And in 2020, he came out and was famously shilled Bitcoin right before the massive rally after the COVID crash. When I was in the office, like we were primarily trading on Trump tweets. This is like before like quite normalized that Trump will get on Twitter and just do something that's very like unique to him. And the market is much more used to it today. Like the markets had never seen anything like that. We launched Canto to a ton of hype. It was super interesting. We had like hundreds of millions of dollars of TVL flow, which is a lot back then. Also like billions of dollars of trading activity came on board like in the first few months.
What's it like starting a company with your brother? Because I have a brother.
Cost of capital has never been lower in crypto. We launched TH Gold, which is like a yield-bearing gold. And then we're launching THUSD, which is a yield-bearing dollar that is backed by gold.
Gold doesn't actually provide yield as an asset.
Yeah, Japan, Korea. Primarily because like we've just gotten hit by this like wave of like memory capacity constraints.
Silver, uranium, these are all commodities that also get impacted.
Uranium has definitely been pumping because of the AI trade. People who are gold bugs are also uranium bugs.
Gold and silver always remind me of like Bitcoin, ETH.
We're working with the largest gold merchant in Singapore, Mustafa. I'm the founder of Theo Network. We're a tokenization platform and also a tokenization platform primarily focused on fixed income and commodities today, but expanding into the broader set of traditional assets. We're focused on making RWAs not only available to global users, efficient, but also in the form factor they like. So that would be like yield-bearing products and also like liquid and leveraged products, but make them also tradable and liquid and available on chain. So not just tokenization, but we handle the full stack, the full life cycle of an RWA, including minting, redeeming, liquidity provision, leverage products, like the whole end to end, so that they become actually usable on chain, not just kind of like representations that are held there. And before Theo, I built a different project in crypto, DeFi focused EVML1 in the earlier days. I ran the DeFi bubble. Before that, I was a high frequency trader at Optiver, where I ran one of the largest oil options market making desks in the world. Before that, I was a macro trader at Tudor, where we traded gold, commodities, sovereign debt, equity indexes, etc. So yeah, and then I got into crypto right around I was in crypto for a long time, mining Bitcoin, investing. Then I kind of wanted to go full time, right? When DeFi became really huge and active, I thought, this is kind of where the future of finance is heading, where a lot of the firms I worked at are trying to build technology for. And I think, where the vast majority of the growth in the financial markets is actually going to occur.
So just to kind of slice it a little bit, so you worked at Tudor Investments, and you said you worked directly under Paul Tudor. Was that correct?
Yeah. Sorry. Go
Yeah.
ahead.
Yeah, I think for people who don't know who he is the person who became famous for predicting Black Monday. And so what was that like working with him?
No, it was interesting. I mean, he's famously a huge gold bug as well, and also was when I was working with under him, we were actually, I think, buying Bitcoin futures as well as part of the portfolio. I think it was part of his personal portfolio. So the firm had primarily been transformed into like a family office at the point that I had been working there, because he had been running it for 30 years at that point. So I would say half the capital was directly managed by him and not the team I was on. So that was like roughly 3 billion. And yeah, we would trade sovereign debt, gold, commodities, equity indices against each other. So it was primarily to showcase macro views. But like I remember at the time I was there, Bitcoin was trading at 13K, and he was like, well, I think like at the time I was there, what was going on was sovereign debt across the Eurozone and Japan was actually negative. So it was a weird scenario where you would like bonds, but you're actually paying to hold the bond, which is, I think the first time in history that happened, and probably the last time that's going to happen again, because it doesn't really make sense. Why would you lend money out to lose it? So I mean, the reason, by the way, was because the central bank funding rates were actually negative. So to deposit into a bank, you'd actually have to pay the bank, because the bank has to go pay the central bank to actually have a depository account there. But that's obviously like a very awkward scenario, because it creates hyperinflation under an inflationary environment. And so we were like yeah, allocating towards gold pretty heavily, and also Bitcoin as like a inflation hedge at the time. So this is 2019, and then obviously, in 2020 he came out and was famously shilled Bitcoin right before the massive rally after the COVID. I think that was definitely a very interesting time to be a macro trader, a very interesting time to be in that office specifically, because I mean all the predictions around like what we thought was going to happen in the next 5 or 10 years because of this monetary policy actually ended up happening.
Wow, that's amazing. What was like the biggest lesson you'd say you learned from him in general at the time?
Yeah, I mean, so I think he was like good at two things. Like one, I think he took kind of a longer term view on markets. So it was like there's like a bunch of stuff, like primarily because the way that the financial system works, like the effects of monetary policy, like cheap debt and you know um, balance sheet expansion at the Federal Reserve, like these things take time, like to actually like show up in the markets. Like they have knock-on effects later on. So like of course in the beginning, if you print money or you reduce the cost of debt, like you'll see growth of like inflationary assets like stocks, et cetera, that benefit from like price increases or like additional capital availability. But the actual knock-on effects, like in terms of like inflation and the value of money, I mean that takes some time to kind of show up. It took about 10, 15 years. So that was part of it, like viewing it from like viewing it from like up uh can kind of like make you a lot of money if you are able to maintain that view for like 5 or 10 years, right? Like if you think, okay, like debt is super cheap and like it doesn't really make sense right now, like it's hard to kind of benefit from that trade like in a year or two, because those effects won't really show up. Like there's a lot of ways that money is kind of like access, like there's a lot of things that act as a monetary sink, like assets and um, debt and stuff like that that can be bought up initially, that go up first and before the monetary, the effect on the money, on the money supply, or like the effect on the value of money kind of shows up. So that's one thing. The other thing is like I think he was really good at being reactive to the market too. Like he was always good at like and what I mean by that is it's like the market can like react much more aggressively, I think, to certain uh like let's say geopolitical risk. Or, so when I was in the office, like we were primarily trading on Trump tweets, because Trump. This is like before, like I think like it's now like quite normalized that like Trump will get on Twitter and just do something that's like very like unique to him. He'll basically like he could tweet something about the market, a specific stock on that day. He could even make just a comment about like some other politician or other country, right? So he's very like unique in that sense, he's unfiltered as a politician. And I think that the market is much more used to it today, outside of like major events like war in Iran or like specific tariffs. Like he can make comments about almost anything, because I think he just has his own personal brand. And but at the time that was really unique. Like the markets had never seen anything like that, like a sitting president. We were trading that a lot, like just his tweets and stuff, because market like heavily overreacted that. And especially the tweets towards Powell in 2019, where he was basically claiming that he was going to replace him, and also like trying to apply significant pressure to influence the rate decisions, because that was a big thing of his like the later end of his presidency in 2019. So yeah, that was big. We were trading that heavily as well, and I think because that was the only really interesting thing in macro at the time. It was one of the most bizarre periods, because again, like when sovereign debt is negative, equity volatility is nearly like it's like the lowest it's ever been. It's under 12. Gold was flat. It didn't even move at all. Like gold literally had not moved in like years. It was the interesting thing, I guess, at the time, because it was moving so much. But it was like a small market. I mean, $30,000 a Bitcoin. That means that the market is like 300 billion, 200 300 billion. It's like tiny, right? So it's not really like something that you can size it. Bitcoin futures had just gone live on the CME, so new market. And then yeah, like we didn't do as much emerging market stuff on that desk anyway. So it's not like, I mean, I think that would have been the interesting stuff, right? Like because I mean, you can like Brazilian debt, Indian debt, Southeast Asian debt, like like that stuff's kind of interesting at the time. But yeah, when I was there, it was like one of the lowest volatility periods in history. I think in history is the lowest vol period for global macro assets. And so the only interesting thing was that Trump was kind of just, he was expressing his opinions publicly, and it was just kind of like going from there.
I love that. And then from there, how's it been founding a company by yourself, going from a trading job to being a founder now?
Yeah, so I mean, I have two co-founders. We all went to college together. All were traders as well afterwards. And so I mean, yeah, one of them was at first me, another one was at IMC. So I think like, you know, it's easier for sure when you have a super strong team that you can kind of trust, that you have great chemistry with, and are also aligned with the same goal and view of like, where this market's headed, where this industry is headed. Uh, I think it was definitely a rough in it. I mean, it was okay. I think it was like a big learning curve when I started the first business, the blockchain that we launched. It's called Canto. Yeah, that. But I think what made it like nice is like we had like another co-founder involved in that who was like a much more experienced, older, senior guy who kind of like explained all the go-to-market stuff, like explained how to raise money, like explained like kind of how do you like yeah, how do you build a product? How do you like sell a product to customers, especially over the internet and kind of in a consumer facing way? Whereas like our primary kind of goal objective when we started Canto was like just to actually learn how to build a blockchain. So we did that. That was super exciting because the technology was like much newer back then. It also was like much more exciting in the sense that like the possibilities were endless back then. I think like the fixed idea of what a blockchain could do for users, for developers, for institutions who onboarded was a lot more fixed. Sorry, a lot more open. Like we could have had an Uber on the blockchain, we could have this on the blockchain or that. And now, to be fair, like what we were focused on was financial primitives even back then. But I think like, there's like a million possibilities for what this could become was super cool at the time. So yeah, we did that in 22, late 21, early 22, after I just left trading. I mean, I was actually in between jobs, so it was an opportunity for me to figure out what to do. And then, yeah, like we launched Canto, Canto a ton of hype. It was super interesting. Like we had like hundreds of millions of dollars of like TVL flowing, which is a lot back then. Also, like billions of dollars of trading activity came on board like in the first few months. And so, yeah, it was. I think it was super interesting. Plus, it was a very community driven product. I think again the learning curve. Another learning curve for sure was managing people. Like that was huge.
Yeah.
Like yeah, I had managed a small team at Optiver, like a few people, but I think that like managing like a proper engineering team and also like running like marketing and go to market function at the same time, raising from investors. I mean, there was it was a lot to learn because it was much more of like a general had done before.
Hmm. Actually, is one of your co-founders your brother?
Yeah, yeah. We are brothers. I mean, we went to college together as well. We're like roughly the
Uh,
same age. Yeah. So, and then he was a
wha-
trader up as well.
Interesting. What's it like starting a company with your brother? Because I have a brother and we've like played around with the idea of working together.
I think it's good. I mean, I think it makes it easier to stick together in the long run. Also, like when times get really tough, like I think like a big thing about being a founder. It's like and it depends, right? Like maybe you're the type of founder who has a linear upward trajectory, and like it's just always up. I mean, like I know that's rare, but it happens. But and then like sometimes you might be a founder who's like in the dumps for like 5 years, right? Like there's like I think each like journey is somewhat unique. Like everyone's life is unique, for example. But I think like especially building a company ends up being like pretty unique because there's no set path to success. If there was, it wouldn't be like such a big risk or wouldn't be such like a like whatever like a difficult thing to do. And so like sometimes yeah, like sometimes you pick the right idea at the right time and with the right team and you're like off to the races and you get to the whatever your finish line you were trying to get a hiccup. Sometimes you have to spend like a long time uh you know just figuring it out before you really had any momentum. And so I think working with like someone that you respect, you trust, but also like that that you're in it for the long run with it is good. I think it only works though if like you guys have a different skill set or like a complementary skill set and but an alignment on like the vision. So which is the case for any co-founder, right? Like if you're gonna bring a co-founder in, you need to bring someone that you respect, someone of like equal or greater skill than you, and has like orthogonal complementary what do you call it complementary uh, yeah, abilities to you, so that you guys kind of fill each other's gaps and grow the company around that. Like otherwise, if it's just like if it's just because it's family, then it won't be successful, or you will feel over a long period of time like okay, this might not have been the right choice. And so I think that's something to consider as well. Like you have to be kind of objective about their abilities or skills. But I think yeah, like I would say like me and Arjun have like complementary skills. Like I think he's an excellent deal maker, excellent negotiator, excellent like operating founder. I have much better, I think, at product research. like running like yeah, like all the finance related stuff. Like that's my point of expertise, and so yeah, I think partnership there.
Oh, that's so interesting. So basically, you guys kind of came together and you have a third co-founder and you founded Theo. What was the story behind naming the company Theo?
Yeah, so I mean, we're traders, so I think like when we build trading systems, like we generate something called a Theo price. I think that was part of it. The Theo price is like what we're like obviously like basing all of our strategy, all of our pricing around, like liquidity provision around. Like that's kind of like the center of like the machine and how we trade. But also, I think it's like we're thinking about like what's theoretically possible. Like I think the whole point of crypto blockchain is that like we're trying to create things that are that aren't possible without them, without like the permissionless global infrastructure that blockchains enable. And so we were thinking, okay, like theoretically impossible. It's like that's what we're building. We're building what's impossible today, but like it's possible in the future.
Oh, that's so cool. I love it. And with Theo, basically, what do you think has been the hardest part so far of building Theo in terms of the product itself? Is it, the tokenization part of it, or making sure that there's actually liquidity around the token, or what's been like the really, really difficult part of it?
Yeah, I would say both. I mean, I think the most important thing is obviously that we have strong partnerships today with like major banks and like asset managers. Those are Standard Chartered, Wellington. We're working with a few other major ones right now as well to onboard. And then like it's important that we have those partnerships because we need to like the assets that we provide to people. Like people need to have faith in them that they're being run by good faith operators that the underregulated environments, and that there's no like one day they won't wake up and there'll be like issues with accessing them or redeeming, etc. And so that's on one side, and getting those partnerships is hard because people move slowly in trad, and it's not I think the crypto opportunity was a much like it is. I actually think it's right now like a huge opportunity for financial institutions to onboard and like actually access customers. I think the cost of capital has never been lower in crypto. Like it's extremely low right now. I think there's a ton of demand for these things in somewhat of a bear market today. Not like a full bear, but like just like local bottom. I think um, that, but I do think that like institutions always move slow. Like even on their own internal objectives or initiatives, like they have like a multiple layered approval processes, and they have to bring in like a ton of like stakeholders. And so I think internally, so I think that like which makes sense. Like they're known for stability and it was like like reliability, not known for like rapid innovation and kind of like being at the forefront of whatever like consumers want. Like that's not their business. So I understand, and that's always been hard to like you know build around that timeline of approval and like kind of like shipping products. And so always been one part of it is like trying to getting to our partners to move quicker and helping them kind of align them internally, of course, sell through them. uh, the other thing is, of course, like providing liquidity for products that have redemption periods that aren't fully like liquid on you know on issuance. And so I think like yeah, gets complex. Like for example, our like a THUSD product, like we have to like maintain like different positions and also like maintain like slightly different durations and liquidity profiles so that we can kind of mimic the effect of like instant redemptions while like ensuring in the background everything's fully collateralized and there isn't any issues around like a bank run, for example. So like because a crypto one thing that definitely makes it more difficult is preferences on chain for RWAs and like any type of yield bearing product specifically, but in like any type of RWA in general, that like you have to be able to redeem quickly. It needs to stay at par always. Like it can't trade away from par. And then uh, like it needs to basically have like a certain yield profile as well. So like there's like uh, a lot of constraints around what actually works on chain because users are specific about what they want. And the issue sometimes is that people that actually make these markets on TradFi aren't involved in crypto as much, or that they don't want to deploy capital as heavily. So we have to work around that, and to making RWAs useful isn't as simple as just issuing them on chain. It's actually quite complex.
Yeah, no, I can imagine. So, well, your first product was TH Gold, right?
No, it's THUSD. We bought actually our first product was a on-chain carry trade. So we focused on capturing yields from Hyperliquid and other perp dexes using Bitcoin and Ethereum, and we did that in 24. Then we transitioned to RWAs in early 25, focusing on initially money market funds like TH Bill, and then we launched TH Gold, which is like a gold yield bearing gold, and then we're launching THUSD, which is yield. It's actually a yield-bearing dollar that is backed by gold and gold hedges. And then we're launching a broader set of RWAs, including like the broader commodities complex, silver, oil, and then also copper. And then also we're going to be launching credit products and stocks. So like that's like the kind of the next like 3 to 6 months is like the full complex of RWAs. But for now, we're launching THUSD, planning to grow that to 500 mil to $1 billion of capacity, which is primarily like going to hold TH Gold and run and hedge it.
So with TH Gold, I'm actually quite curious because traditionally gold doesn't actually provide yield as an
Yeah,
asset. How do
yeah,
you kind of ensure that gold is like TH Gold is providing yield?
yeah. So what we do is we basically manage. So we take we buy physical gold. We do a sale lease back to So what that means is like we buy gold in a vault, then we swap the gold for gold in a manufacturing facility or in a showroom, and we lend it to the to either a major multi-billionaire gold merchant or a transnational gold refinery. But right now we're working with the largest gold merchant in Singapore, Mustafa Gold.
Oh, nice.
Yeah, yeah, and they have about I think about a couple like 300 to $400 million of inventory right now that they need to finance. It's in physical gold. It's in their store. It's insured, and then it's reinsured on top of that. And so and then they also cover and then the fund is also backed by like a fund sponsor who is like a first loss on that. So if somehow the insurance doesn't work and also Mustafa gets robbed or something, then like there's a 20% uh, buffer as well. So the idea is like very simple though. We help them. We basically give our gold to them. They put it in their showroom. They sell it. As they sell it, they buy more gold. And so like it's in gold terms. The loan. It's not exactly a loan. It's actually a lease. So imagine if like you own like some real estate or like you own some physical property, you can lease it to someone to use like, and then by when they use it, they pay you some. That's where the yield comes from. And the best part is they actually store it for us. Like if you buy physical gold, let's say at auction, and you don't want to hold it physically like in your house because you can get robbed or if someone knows they can take it, right? So like you've just paid a facility usually somewhere between 20 and 70 basis points annually to physically store your gold and insure it, because it's not just the gold, like the not just the storage cost of gold. It's actually the most expensive part of dealing with physical gold is the insurance around it. So whether you transport it, whether you store it, whether you whenever it's in flight or out of your hands, you have to insure it. The insurance costs tend to stack up, and that's where that 20 to 70 basis points annualized kind of comes from. And yeah, we basically get free storage and insurance paid for the merchant who leases our gold on top of the yield that they pay us. And so yeah, this is getting it. So this is something that we're planning to scale up pretty substantially because I think that our customers really value that offering of a yield, like of a gold that actually grows, not one you have to pay to hold. The context, you can redeem for physical once a month at the end of each window as it rolls. So it's effectively similar profile if to have if you had just a vault.
That's so interesting. So I'm actually also very curious about so when you're kind of deciding which products, how do you kind of weigh the pros and cons in terms of, what you think there would be a demand for versus what's easy, like low-hanging fruit versus, what's compliance wise?
Yeah. So I think it's usually a mix of we look at market size, we look at trading volumes, like off and on chain, and then we think about also like kind of we speak with customers, we see what they want to be trading on chain in size and volume, and then I think the other most important thing is like we think about things in terms of like yeah, like I think crypto is very yield oriented, like in general, like as like an underlying yeah, it's very yield oriented from the perspective of tokens, even from product launches, and real yield. I think real yield is now becoming front and center because the yield purely from token incentives has kind of come off. So now I think like yields that felt kind of uncompetitive, that 7 to 10% range are very competitive in today's environment. yeah, I think that's one thing. Other thing is like, yeah, like we just think we speak with customers, we think what's growing. Yeah, so that's like markets that are already substantially large or like have yield profiles that make sense. We also like to think about like, what markets are growing now. And so like we and that we can kind of launch and grow into. So that's like another something that like, outside of like existing customer demand and market size that we can bet on.
Interesting. And from your own perspective, because I also know you have a background, you were a macro trader. What are some markets that you think like exciting for you in this moment or are growing actually?
Yeah, do you mean like globally? I guess like I mean I think that like the Indian market's growing pretty fast. Like that's like super exciting. Although like it's a little bit I think like yeah, like I think like the large cap Indian markets have pretty strong growth, like from a like earning standpoint as well as like revenue expansion. I think the mid cap and low cap there might be a little bit more like actually very crypto like in nature. Like there's like a lot of like speculative like businesses. Like people are like are IPOing so many businesses now in India. I think it's like a really hot stock market. That one's it's almost like crypto in the sense that yeah, it's like very like you might have a business that makes $2 million in revenue and you'll IPO it if it's like and then it'll be trading at like a few $100 million and like that's kind of hot about it. So it's definitely like a super dynamic, interesting market. Yeah, I think that's exciting. Um, in terms of like commodities, I think yeah, I think gold is obviously hot. I think it'll remain hot. I think that there's like secular buying demand that's not going to go away right now. I think that there's very little supply expansion. Like it takes a few years, a bare minimum, to have greenfield projects come online. I'm sorry, to have brownfield projects come online, and another 10 years for greenfield projects. So it's like mine expansion is not simple, and like miners are like the primary sellers of gold. I mean, like they're like buyers of gold rarely sell. Like they're like some of the least like oriented around sales. Like they might turn their gold into jewelry, they might give it away to family, they might like whatever, but they rarely sell. So I think like unless you have a crisis moment, it doesn't really come off. So I'm excited about that. Bitcoin is like super cheap right now. It can definitely take a dive and go to like that 40 to 50K level, but I think that people buying Bitcoin today are gonna be pretty happy in 2 years. In terms of I guess yeah, like what else? I think if you're gonna like look at kind of like debt, like I think that emerging markets debt is pretty good right now. So like there's like some. I think if you, I haven't really been looking too much into it, but I do think that like there's some pretty high yielding stuff in like in Latin America right now, debt wise, like Mexico, and then also like I mean that trade has been playing out. Like people have been lending in Mexican pesos just because of like the kind of the offshoring from China, or the near shoring that's been occurring. But yeah, I think that's something that's interesting as well. And then yeah, I think like US outperformed like consistently with low vol. Although like yeah, like we had like pretty significant outperformance from like Asian equities recently. Like Japan and Korea are just on an absolute like unstoppable tear. Uh yeah, those are probably the most interesting like equities markets right now. Probably just like Japan, Korea, primarily because like they're so oriented around chip man. Like so much of their economy is specifically built around a few companies that have just gotten hit by this like wave of like um, memory capacity constraints. And now like they're just like I mean I think Samsung Electronics is up 4x in like the last 2 years. SK Hynix, which is the largest memory manufacturer in the world, that one's up almost 10x in 3 years. So it's like these are like major companies. So I think yeah, like it's like, obviously the AI trade related, AI demand related. So that's something that I think everyone's watching. It's actually I think a big reason why where a lot of like Asian oriented retail demand for crypto and like kind of like crypto like adjacent volatility has gone. Like the actual equities markets in Asia are now more volatile than crypto, which is just like which is basically making it so that our like one of the core audience of like altcoins and like crypto trading in general is now focused on equities markets. So you know
Yeah, I get that. So, I was also looking at the into this AI and the chip, obviously the effects of that. And then I've also been seeing a lot of people say that, silver, uranium, these are all commodities that also get impacted. Is that true?
yeah. So I think like the silver. So uranium and that's like yeah, uranium has definitely been pumping because of the AI trade, primarily because like there's a big push now to build out nuclear reactors and also to actually upscale existing reactors, like so enhance their capacity, push them up, because like reactors have like a smaller like physical footprint, and you can kind of plug uh like data centers up near them. So like if you build a data center nearby a nuclear reactor, like you can actually scale up like the actual electrical usage faster than other forms of uh, electrical generation like near the grid. So like that's one thing. I think like uranium as well has basically don't mine any more uranium. Like there's not there's only like two places I think in the world they mine more like a good amount of uranium now. I think one of them is like in Russia, and so like there isn't really much uranium that America mines today that they can enrich into like fuel grade uranium, and so that's probably one of the biggest reasons why uranium is actually rallying so hard. There just is a massive shortage, and we have been turning off reactors a bunch in America, and so like whatever's like everyone kind of assumed that nuclear is going to be phased out into solar and wind, um, and and I guess also nat gas. Like nat gas actually turned out to be the biggest replacement for nuclear, which is kind of like a step backward, I guess. But like that's how they did it, the math, and figured that out in the last 20 years in America. And so yeah, uranium has been a run because there's just so little of it. But I don't really like think the uranium market is super interesting. I know there's a lot of the same people who are gold bugs are also uranium bugs. Like they really think it's like something interesting, and they're like super like, oh, we need to buy more uranium, etc. It's a tiny market though. Like uranium is like such a small market. It's like $5 billion annually, like of mined uranium, like globally. So it's like one of like yeah. That's why I don't personally think it's like something that's super exciting for people to trade. It's just like this tiny market, and it's like the both the supply and the demand side is like yeah, it's fixed and small. So yeah, it's been rallying a bunch, but it's primarily because of just how little of is being mined. And then I think when it comes to uh, silver, I think that's a mix as confluence. Like one, I think we stopped mining as much silver in the last 10 years, and then two, actually the big thing with silver is like it's actually solar panels and batteries. Like silver is a core component in both, especially in photovoltaics, like solar panels, and then also is also a core component in some of these like solid state batteries. And so, China is the primary manufacturer of both batteries and voltaic cells, and so they're also the biggest producer of silver. So they're like the silver market is like really a Chinese market, and silver was already rallying because of like catch up effect to gold. Like gold was being bought up by central banks to like bolster their foreign reserves or like their effectively their balance sheet and their ability to defend their currency. And they didn't want to hold dollars anymore. They felt that it was a risk to their sovereignty. So they're buying gold. Expanding that in their balance sheet. Obviously silver is like a catch-up trade to gold. It didn't move for a while, but then everyone rotated from some cash from gold into silver, started rallying. China decides to ban like kind of the exportation of silver to avoid like because silver is both a speculative commodity and viewed as somewhat of like hard money, but also it is now a nearly utilized metal, like similar to copper. It's like worse at conducting than copper, but it's significantly less um, it doesn't corrode. Like it's like silver and gold specifically are inert, so they don't corrode. They act great conductors, and so used in these like industrial processes. Silver, there's now actually an equivalent demand for silver as is mined annually for industrial processes. That's actually why silver is actually somewhat of a better supply demand profile even than gold. Like when in reality, because people use it for like solar panels and batteries, all that stuff. By the way, but at $80 to $100 per silver price, they stop using them in photovoltaics and in batteries. It's too expensive now. So actually, the demand is drying up to utilize silver in these products because they can replace it with like nickel carbide and other types of like less inert but similar conductivity metals that are cheap or super cheap. Yeah, like that industrial use case is starting to dry up. It's so expensive.
So interesting. It sounds like, gold and silver always remind me of like Bitcoin ETH, the way they move together as well.
That's the idea, right? That's why people were like, okay, we're gonna buy silver at $25 and gold's at 4,000 because it's like, it hasn't caught up, and we think it's gonna catch up. And that's also how ETH and gold work, Bitcoin too work too, because it's like Bitcoin can rally like 30-40%, ETH can kind of like sit around and do nothing, and then like once it goes over a certain level, like it goes over some like kind of like psychological level or some like like it goes to 100K, then like ETH will start doing a massive catch up trade. And I think that's how it's always going to work. Like we saw that happen last year in the summer, right? Like ETH went from $1,500 to $4,500 because Bitcoin went from like 80K to 110K. So it's like similarly, like I think if gold breaches certain levels, you have a massive like a flight to like these other assets.
Yeah, yeah. I think I've used enough of your time as my own personal investment advice. But no, it's really helpful. What I also actually really wanted to ask you about with Theo, coming back to that, is it's really interesting with the new product that you guys launched that you mentioned. It's backed on gold. Because I
Uh-huh.
do know that, in the past, the dollar or like USD was gold standard, and then they kind of moved that. Was that the thinking behind it, or what was kind of the thinking behind doing that?
Yeah, I think there's two reasons we really like this product. And the one is that yes, like this is probably the hardest possible money that you can have. It's dollars denominated in gold. Sorry, dollars backed by physical gold, and yeah, and gold hedges on global commodities platforms. So we think that this is like the most sovereign version of a dollar. Like no one can take it from you. It's physical gold. You can retrieve the physical gold if you need to, and then sell it into the market for whatever you want. And until then, we hedge the gold price exposure for you, and we generate yield. We generate the highest real yield we can get in the market today with under a 1 month duration. And so, I think that both from a standpoint of safety, of sovereignty, of kind of availability and scale, like this product we can scale it to billions of dollars, like many billions, and without seeing a reduction in yield or in safety. So yeah, we think that from the perspective of both hard money, um, ownership over your money, and safety in a kind of a risky global environment, as well as a yield and stability of the underlying asset base. Like we think it's as good gets.
Yeah, no. And in general, a lot of people that I've interviewed for the podcast, one thing they're really, really excited about for 2026, 2027 is bringing all these assets kind of on chain. So I actually just interviewed the CBO at Gate, and he said that's the one that he's looking forward to the most.
Yeah.
And so I just wanted to also learn from you or understand from you, like, what are you personally excited for within the RWA space and overall crypto space as well for 2026, 2027?
Yeah, I mean, I think he's right. Like, I mean, when I look at areas of growth in crypto, when I think about kind of how the technology can, like, when we think about in general, like where an industry can head, like we can kind of think about it from like two standpoints. Like, how does the technology change to enable new functionality, which I think was definitely the phase of crypto from like 2019 to like 2023 or 2022, I would say. Then like now I would say the technology has not changed substantially. It's becoming much more of like a mature environment where it improves from a like efficiency, cost, and latency UX standpoint, but it's rarely shifting from a functionality standpoint. So I think when we think about okay, now that we have this like form factor that we understand well, understand like what it kind of enables, like we can kind of view where like the UX enhancements will arise and the cost benefits will kind of occur, but we can't we are like generally the user flows and functionality. Like it's pretty clear that like the primary value out of crypto is a global, unrestricted, um, fully available market where people can kind of discover counterparties, find new products, access new markets, and kind of move their money around at the speed of light. And so we think, yeah, like we think that onboarding the traditional counterparties, not just like institutions to create products with us, like for example, but also like these larger neobanks and like existing financial institutions putting their stamp of approval on the blockchain and connecting because they're the ones who are the access point to the financial system for billions of people. And so having them on board and build their own platforms that are crypto native, but that are open access and enable, businesses like ours to kind of move our products into their platform or sell into their customer base. Like that's because, yeah, like even for the next 20, 30, 40 years, still the primary access point for the vast majority of people in the world to into the financial ecosystem will come from like larger financial banking platforms or institutions.
Yeah, no, definitely. I think that's what I'm also excited for as well, to see. Yeah, I think those were all the questions that I had. Thank you so much for joining the podcast and
Uh,
really appreciate your time.
awesome. Thanks so much, Tanya. Really appreciate you having me on.
Yeah.
Thank you for listening to Off the Record. If you like this episode, like, subscribe, and leave a review. It helps the podcast grow. You can find more episodes wherever you get your podcasts. See you next time.